everyone. Welcome to the All-in-One Loan Lunch and Learn presentation today. I would absolutely recommend that you jot down any questions you have as we go through the presentation. That way you can always reach back out to Shireen if you have any questions with how the product works or if you have just general questions about the product in general. But I'd like to introduce myself to you first. My name is Erin Wood, and I was part of the team that initially launched this product back in 2005. So I do have a unique experience and perspective level on this product to offer myself as a subject matter expert to any loan officer that's interested in learning about this product or offering it to their clients. Now, I also work with Shireen, and she is going to be your mortgage advisor. She also has experience with the all-in-one loan as well as mortgage experience just in general. So she will absolutely be able to help you with your financing needs. Set the stage a little bit just so that everybody is aware of kind of where we're at today. And there's 48 million households in the US that owe a mortgage. So we're in good company. There are a lot of us that are out there. But unfortunately, collectively, we have $11 trillion worth of mortgage debt that we're dealing with. Now, contrast that for me for a moment, if you will, against what we hear as a national crisis with the student loan debt at 1.5 trillion. I do find it odd that there's nobody talking about how we as homeowners can get out from underneath that $11 trillion worth of mortgage debt. Now, one of the biggest culprits to us reaching that debt level is the amortization schedule, which I'm sure if you don't know this or not, the amortization schedule has been in use in the US for mortgages since 1938. It has not been innovated since it was launched. And it hasn't been because it's a reliably profitable way for the banks to continue to make money on us as consumers or homeowners. And when you break down what a mortgage amortization schedule is, this is completely, you can look this up online. A mortgage amortization schedule is the repayment of your mortgage, and each payment is first and foremost front-loaded with interest cost. Whatever's left over, that's what gets applied to the principal balance. Now, as the loan matures, more of that payment is going to go towards the principal balance. But unfortunately for us as homeowners on a 30-year fixed rate mortgage, that halfway mark doesn't happen until around year 22, 23. Now, there is this myth that we believe in as consumers, and it's one that we hold on to wholeheartedly. That myth is if we have a low interest rate and we have a low monthly payment, then gosh darn it, we must be getting a great deal, right? That's evident in our behavior as consumers because we actually refinance or recycle our debt every 5 to 7 years. Sometimes more often than that if you're chasing interest rates. Now, when you factor in our behavior as consumers, low interest rates do not come with low interest cost. Now, up on the screen, that amortization schedule, each column represents a year. Go ahead and count back 5 to 7 columns. How much in interest are we actually paying versus having principal balance reduced? We're paying 5, 6, 7, 8, 9 times the amount in interest cost. And every time we refinance, we're just restarting the clock on this amortization schedule, which is why we say low interest rates don't come with low interest cost. Because when you factor in our behavior as consumers, we are, again, every time we refinance, we're resetting this clock, paying the bank more in interest on the same debt. And when you factor in the impacts that the mortgage amortization schedule has, it definitely eliminates a good portion of the financial benefit that we're able to achieve in even owning a home. Now, in this example, we're going to go over how I would purchase a home for $450,000, but at the end of the day, I will have paid back over $600,000 in total payments, including the principal and the interest. So let's break it down a little bit. And that $450,000 purchase, let's say I'm going to come into the transaction with $50,000 of my own dollars. That's going to be my contribution to my investment of owning my home. But that means I need to finance $400,000. Now, if I got a 30-year fixed rate mortgage at 3.5%, by today's standards, that's a very decent deal. But assuming that I stay in the loan the entire time, I will have paid back $246,625 in interest cost. I had to pay back over half the amount that I borrowed in interest cost alone. Now, what I like to do is break down the interest costs that I'm paying to the tens of dollars. And I do that on purpose
Because personally speaking, I can't speak for everyone on the phone today, but personally for me, I've never held hundreds of thousands of dollars of cash in my hand before. That's not relatable to me. They might as well be talking to me about interest costs in the millions of dollars because it's not tangible. I can't relate to it. But what I can relate to is $10. I've had a $10 bill in my hand before. So if I break down those interest costs to the tens of dollars, for every $10 I borrowed in this loan, I had to pay back $6.17 in interest. So I borrowed 10, pay back 16.17 because I also have to pay back the amount that I borrowed. That's going to ultimately be a 45% increase in the purchase price of my home. And that's with a secured low 3.5% interest rate. By today's standards, this is braggable. I would almost venture to guess that a good majority of us would, our friends and family and our neighbors would know about this low interest rate because that's braggable. And you could completely argue with me that my home is going to appreciate, so I'll recoup those costs, right? Well, I'll agree with you that my home will appreciate, and if we use that 3% model, my home is going to be worth over $1 million. So for me putting $50,000 of my own money into a transaction, that's a pretty good investment to get a return on. But because of the interest costs that came with that perceived secured fixed low interest rate mortgage, that cost me 23% of the cumulative wealth I would have seen had I not had to pay that much in interest cost. And when you boil it down to the piece of the pie we have each month to spend on not only our lifestyle, but our expenses, our other bills, even our future savings for retirement. It's no secret that America is vastly underfunded for retirement, and we've gotten better over the years at saving. But when you think about ways that you can save money outside of having another income stream, you can do things like change from cable to streaming services. You can change your cell phone provider or your car insurance provider. But those changes are not going to afford you to retire early. Those changes won't be able to send your kids to college. But those are some slight changes that we can make. Now, when you look at the overall picture of what we're spending money on, mortgage interest actually is one of those huge areas that we still can innovate and change to our advantage. We've absolutely gotten better at saving over the years, don't get me wrong, but we still have a lot of areas where we can continue to use our money to our advantage versus just giving it to the bank. And that's really where the all-in-one loan comes in. It's a smarter way to borrow. It's an innovative way where you can use your money to your benefit versus giving it to the bank. And this is different than the way that your parents have mortgaged and your grandparents have mortgaged, but it's a new and innovative way. Now, for homeowners and home buyers alike, there are certain things you get to take advantage of with the all-in-one loan that traditional financing was never intended for you to take advantage of. First and foremost, you get to see a reduction in your principal balance 2 to 4 times faster than you would in a traditional loan. You're going to see a reduction in interest costs every single month. You're going to have the accessibility to reach in and utilize your equity dollars to your advantage without needing to refinance. And all of this happens without you needing to change your budget, your lifestyle, or your spending habits. We're making this as easy as possible for you to be as successful as possible using your money to your advantage. Now, I'd like to go over the product's background because I do get asked very often, well, Erin, if this product is so great, how come I've never heard about it before? And we launched this product back in 2005. I was there, it happened. But 2005 was a different lending environment than we have today. We had industry professionals that were encouraging borrowers to leverage their equity. We even had some professionals that were telling borrowers to not pay off their mortgage, that it was a better sound decision to leave that mortgage on the balance books. So the messaging of the all-in-one was a little counter to what the mainstream was. But the clients that got into the product in 2005, 2006, 2007, even the beginning of 2008, they were better equipped to handle the secondary market crash of 2008 and the residual effects of 2009 and 2010. These borrowers were less likely to be underwater on their homes. Now you fast forward to present day, and this product is available in every single state in the nation, which is an amazing milestone for this product. The only caveat to that is if you're in Texas, we can currently only do it on second homes and investment properties. We're working with legislation to open this up for owner-occupied properties for our Texan neighbors, but as of right now, it's just second homes and investment properties in that state. Outside of that, it's available for everyone to take advantage of. We can even go up to a 90% LTV for a purchase or a rate and term. We have the ability to put this on an investment property, a second home, or even an owner occupied. So the product's absolutely grown since we've had it. But the number one thing I am most proud of is that since 2005, we haven't had a single loss, default, foreclosure, or delinquency on this product. Not a single one. Now, I'm not sure if you understand the weight of that statement, but that's a very heavily weighted statement because that's something that Freddie Mac, Fannie Mae, FHA, VA, USDA, they couldn't say that same sort of thing, not by a long shot, because America as a whole actually has the highest default rates of any other country out there that offers home financing. But when it comes to the all-in-one, we haven't seen a single one, which is a huge testament to what happens when we give borrowers more control over their money versus having them give that to the banks. Now, what makes this product so different? Why is the all-in-one stand out aside any other product out there? And it's because it's a type of offset mortgage. Now, if the term offset mortgage is new to you, that's okay. The goal is by the end of today's call for you to be comfortable with the mechanics of how it works, understand where it came from. That way you can make the best decision on if this is going to be something that will benefit you and your household. But the all-in-one loan, just in and of a nutshell, it allows borrowers to avoid copious amounts of interest costs that are calculated due to it being attached to an amortization schedule. Now, the offset mortgage in its basics of terms is home financing and personal banking combined, which that might sound completely foreign to you, but when you think about the dynamics of it, it actually makes a lot of sense. And I'm surprised that this product isn't mainstream more than it is already. But offset mortgages was not something that we decided to just think up overnight and throw it to the market to see if it sticks. The exact opposite is true. In fact, we've had offset mortgages here in the US for quite some time. We just use them on the commercial lending side of things. So unless you've purchased or refinanced a commercial property, it's not likely you know these options exist. Not only that, but we typically call them different names. We call them sweep accounts, universal accounts, and ZBAs, zero balance accounts. So again, the functionality has existed in the US for quite some time. We were just the first to bring it to market in the residential lending space. Now, the offset or all-in-one type mortgage was actually innovated in countries outside of the US, most notably Western Europe, and then Canada got on board, and then Australia and New Zealand also decided to follow suit and offer offset or all-in-one type mortgages to their homeowners. Now, some differences between these countries in the US in terms of residential lending. Here in the US, we have a very robust secondary market. If you've ever had a purchase or a refinance and say 8 to 10 months down the line, you get notification that your servicers changed, that means that your mortgage was bought and sold on the secondary market. Now, these other countries, they have a secondary market. It's just not as robust as ours is over here. Another differing factor is that these countries do not allow their homeowners to write off the interest that they pay on their home loans on their taxes. So as a way to innovate those industries and a way to encourage more home ownership, they came up with the offset or all-in-one type loan. And then again, we developed this in 2002 and brought it to market in 2005. Now, how does an offset mortgage work? I'm going to go over these basics, and this might seem like overkill for some, but I like to believe that everybody that joins my calls are pretty smart, and I would almost venture to guess you're going to do your due diligence and do your own research on this product. Which means when you go online and you Google what is an offset mortgage or how does an offset mortgage work, it's very likely that you're going to be pulling up articles from the UK, Canada, Australia, and New Zealand. I know this because I've pulled these articles up. And the way that we do the all-in-one is slightly different than how it's done in these other countries. So I want to go over this real quickly, just so that you can understand the differences between how they're done in those countries and how we do the all-in-one. That way you can make the best educated decision on if this will be a product that will benefit you and your household. So if I was to go to Canada and purchase a home using their offset or all-in-one type mortgage, this is what it would look like. I would have my mortgage and I would have a cash account of some sort. Now, this cash account typically doesn't earn very much, if any, in interest. They're typically not interest-bearing accounts. These cash accounts also need to maintain a certain amount on deposit, otherwise the borrower will not qualify for the offset feature. So ultimately, it ends up becoming a stagnant cash account that you can't use. But what they will do is give you credit on your mortgage for the amount that you have in that cash account. So let me put some numbers up so it makes a little more sense. And if we're keeping with that $400,000 example, if I had $100,000 in my cash account, they're now going to give me credit for that on my mortgage, and my interest will be calculated at $300,000 versus $400,000. So this borrower is absolutely going to save some time and money on their mortgage. But some things to still consider. It's a stagnant account that you can't use because you don't want to dip beneath the threshold. You're not earning any interest on it while it's sitting there. And there's still an amortization schedule attached to the mortgage, so they're not getting out of it that easy. Now, in the all-in-one, we've changed things up a bit to make it a little bit more user-friendly for consumers here in the U.S. But before I get to that, I want to make sure everybody on the call understands this one thing because it's pretty important that you do. Here in the U.S., the banking system purposely keeps your checking account separate from your mortgage. They do that on purpose because it's to their benefit that they can keep your money separate. In the all-in-one, we've removed that invisible line and we say, you know what, go ahead and let your checking account talk to your mortgage because that actually makes a lot of sense to do it that way. Now, for some of you on the call, it might seem like I'm some crazy lady and that I'm giving ideas out of left field, but I promise you I am completely sane and this makes a lot of sense when you think about it. So let's walk through this. When you get paid every other week, every month, what do you do with your paychecks? We're not putting them under our mattresses, right? We put them in our checking accounts, don't we? Well, what's the main reason that we even use a checking account in the first place? Because checking accounts are safe, they're secure, and they're easily accessible. Any other reason you would use a checking account, and it'll fall into one of those three categories. Now, in the all-in-one, your money stays safe, it stays secure, and it's still 100% completely accessible. In fact, the deposits that are made are FDIC insured for the amount of time they're in there. You have all of the accessibility features that you're used to today. In fact, you get a Visa card that's also backed by the star logo. So you can use it as an ATM, or you can go and use it as a point of sale like you normally do with your cards today. You can order personal checks. You can set up online bill pay. There's a mobile banking app where you can take a picture of a check and deposit it into your account directly from your phone. You can add additional users to the account. You can link external accounts for ACH transfers. So again, the functionality and the usability of the all-in-one is exactly the same as it would be for your regular checking account down the street. It's just now we're putting your money to work for you versus the bank. What do I mean by that? Well, when you make a deposit into your all-in-one account, at 12 a.m., the amount of that deposit will sweep to the mortgage side of the account, reducing the balance by the amount of the deposit. Makes sense, right? Well, you're probably thinking to yourself, okay, well, Erin, yeah, I get it. My paycheck goes into the account. That reduces the mortgage by the amount of the deposit, but I have to spend that money. I have bills to pay. I've got extracurricular activities for the kids. I need to spend that money. I can't put it all towards my mortgage. And you know what? We agree with you. We don't want you to change anything with your spending habits. Whatever it is you're doing today, do tomorrow in the all-in-one. Please do not change a thing. So inevitably, when you spend money out of the account, the balance is going to go up by the amount that you withdrew. Still pretty easy to follow along, right? What this slide is displaying or illustrating is that your money is working for you, keeping the balance low until you go to spend it. That's important because of how we calculate interest. The way that we calculate interest in this loan is different than any other product out there. Remember, there is no amortization schedule attached to this loan. There's no predetermined interest cost in this loan. You as the borrower get to control that to a degree with your deposits and spending habits. So every single day after the deposits sweep to the mortgage side of the account, we're going to be taking a calculation of the interest. We do that by taking the index plus the margin that you choose with your loan officer, and that becomes the rate. We're going to times the unpaid principal balance by that interest rate, and then we're going to divide it by 365. And that's going to be that day's interest cost. Now remember, we're not charging it daily, we're just calculating it daily. Every single day, we're going to take a tally of the interest cost. At the end of the month, we're going to tally up those daily interest costs, and that's going to become the interest-only portion that's automatically drafted out of the account the following month. So yes, you did hear me right. You pay principal first in this loan all month long. We settle up on interest the following month. We're calculating interest simply. You as a borrower are paying it in arrears. This is the only loan in America today that you can put on your home that will calculate interest in this fashion. And we never change how we calculate the interest. Throughout the full 360-month term, this is how we're calculating the interest cost that you have to pay. And in this loan, there are 4 ways that you get to save that you don't get to take advantage of in a traditional mortgage and checking account setup. First and foremost, every single deposit that you make into the all-in-one account, regardless of the frequency or the amount, every single deposit is a principal balance reduction. The second way that you save money is with the money you're going to spend. Now, what do I mean by that? So when you have your money in a checking account, it sits there and it waits for you to spend it, doesn't it? I would ask that you ask yourself these 3 questions. Do you buy all of the food that you need for the month in one day? How about gas? Do you buy all the gas you need for the month in one day? And then what about your bills? Are all your bills due on the same day? Chances are you said no to all 3 of those questions, which means you're periodically spending money out of your account as you need to spend it. Well, in the all-in-one, until you spend that money, that's going to keep your balance low, which is going to in turn keep your interest costs low. And that happens all throughout the month. Now, the third way that you save money is by not changing your spending habits, and that includes the current mortgage payment you're already budgeting for. In fact, in 2005, we used to tell consumers, you can go ahead and keep your current mortgage payment with this product. That was our way of conveying to the borrowers to not change their spending habits. Whatever you're budgeting for today, continue to budget for in the all-in-one. So if I had a $400,000 30-year fixed rate mortgage at 3.5%, my principal and interest payment is going to be $1,796. These borrowers are already budgeting as if they have a $1,796 mortgage payment to make. But instead of writing out a check, sending that to the bank, having the bank take a huge portion in interest cost and only apply a little bit to the principal balance, they get to keep that $1,796 in the account against the principal balance all month long. And it's not just the previous mortgage payment that's sitting in there that's helping to keep the balance low. It's also the fourth reason, the leftover cash, your positive cash flow, the money you didn't necessarily need to spend that month. That's going to be sitting in the account with your previous mortgage payment. Sure, it's going to be in the form of home equity dollars, but they're completely accessible to be used if you want to use them. It's just until you do, you get to save money and interest by having that keep your balance low. Now, it's been my experience over the years, there are 5 reasons I continually see borrowers getting into this product. And the number one reason, hands down, regardless of what the motivation is for the financing, is the ability to save an interest cost. Think about that for a second. We're all consumer minded. That's evident in how we shop. We all want to get the best value for the money we spend. We want to get the most for the least amount of dollars. That's evident in how we shop. If we were to go to the store to purchase an item, and after taxes and overhead, it seemed like that cost was inflated, we walk away from those deals because we'll go home and we'll get that item on Amazon at a lesser price, or we'll go to the store down the street. So we're constantly looking for the best deal. We're just so caught up in that myth of low interest rate equals low payment equals I must be getting a good deal, that as consumers, we don't actually look at the amount of interest costs that we're paying as it relates to the principal balance. And in the all-in-one, you get to save an interest cost by using your money to your advantage. Now, number 2 and number 3, just in my personal opinion, I believe they go hand in hand. And I say that because if you are a borrower that doesn't believe in paying off your mortgage, that's okay. There are still other borrowers out there that believe in that same school of thought. But I'd almost venture to guess that means you're leveraging your equity to go build wealth in other areas. And if that's the case in the all-in-one, you're going to have access to those equity dollars 2 to 4 times faster than you could in a traditional loan, and you're going to save money and interest costs at the same time. Now, what happens when we're building equity? Yep, we're reducing our principal balance. We're reducing our credit risk. And if your motivation for financing is to be debt-free or mortgage-free as soon as possible, this loan's going to get you there 2 to 4 times faster than a traditional loan, and you don't have to change your spending habits to achieve it. Now, number 4, this is really where I think the misconception that's out there that this is a HELOC or a HELOC alternative comes in. And I'm going to address that right now. This is not a HELOC, folks. This is a type of offset mortgage. Sure, it has line of credit characteristics. That's evident. However, the similarities between a traditional HELOC and the all-in-one begin and end with the fact that they're two-way instruments, meaning money can come in and money can go out. That's it. That's where it ends. Traditional HELOC products were designed to only allow you a draw period of 5 to 10 years. After that time period is over, as consumers, we're presented with either a balloon payment or a re-amortized repayment schedule. Now, for those of you on the phone that have experience with HELOCs, what is our behavior as consumers when we're presented with balloon payments and re-amortized repayment schedules? Yep, we refinance because we typically don't prepare for those balloon payments. And when we refinance that amount, it changes the trajectory of our financial goals, and we end up paying more in interest on the same debt. So those features don't help us out as consumers like we hope they would. And they're not ever going to be present in the all-in-one. Yet you are going to have the ability to reach in and utilize your available equity dollars at your discretion for the things that mean the most for you and your household. Now, number 5, this is really where, this is the emotional reason. And I am of the school of thought of removing all emotion from any big decisions I make. I just think that's a sound way of approaching things. But there is an emotional reason in the all-in-one that has to be considered, and that is it becomes an unintentional safety net. And it's not lost on me how strange that sounds to hear somebody in the mortgage industry saying that a mortgage product is a safety net. But again, I'm not out of my mind. I am a sane person. And if I hadn't had my own personal experience with this product, I probably would be just as skeptical. But with the way that the all-in-one is designed, it allows a lot more grace and flexibility for the borrower to manage the ebbs and flows of life a lot better than a traditional mortgage or checking account. And I say this because if something happens like life, for instance, like losing your job, having a medical emergency, the car breaking down, the roof leaking, if for any reason you're not able to make a deposit for a month or 2 or 3, or in some cases years, that's okay. You won't have to worry about a late. You won't have to worry about losing the home. As long as there's available equity dollars there to absorb the interest costs, you do not have to make a payment, or a deposit, I should say. The interest-only payments will automatically be drafted, but as long as there's available equity there for those interest payments to be absorbed, then you don't have to make a deposit. And that affords borrowers a lot more grace and flexibility to manage the ebbs and flows of life. Now, the account access and servicing piece of things. We have really great partnerships and relationships with North Point Bank and Merchants Bank of Indiana. They take excellent care of the all-in-one clients. In fact, there's a dedicated customer service line. But what I do want to make sure is pointed out is the closing piece is very different than what you might be used to in a traditional mortgage. Typically, there's prepaid interest that we pay for in our refinances or our purchases, which makes it appear like we're skipping a month. But we're not. We're paying those interest costs at the closing table. And in the all-in-one, there's no prepaid interest. Remember, there's no amortization schedule attached. So we want you to get started right away utilizing your idle dollars to your benefit. So about 3 to 4 weeks after the loan funds, you're going to receive your info packet. That info packet's going to include your Visa card, forms to order checks. You can set up direct deposit, get your online bill pay squared away. You'll actually be able to access the account within 3 to 4 weeks from the loan closing. Now, I've said before on this call that this is an offset mortgage with line of credit characteristics. Well, what do those characteristics look like? Well, here we have up on the screen for the first 10 years, you'll notice the credit limit stays unchanged. Now, there's no balloon payment or forward amortizing repayment schedule, so we don't have to deal with that. But you'll notice that after the 10-year mark, the credit limit's going to start to reduce slightly by 1 over 240, or the remaining 20 years, because there's 240 months in 20 years. So however you want to mathematically work that out. And I get asked very often, well, Erin, does that mean after year 10 I have to make an additional deposit? And my answer is always the same: no, not at all. Because on average, our borrowers are reaching their payoff amount within 8 to 12 years. We have some extreme cases where they're paid off in 2 to 3, and we have some other cases where they've been in the loan since 2005. They're coming up on their 15-year anniversary, and they're already in their credit limit reduction phase, but they continue to stay in the account because they want to have accessibility to those funds if in the event they need them. Now, up on the screen is a perfect example of how an average borrower has utilized the loan. They get into it and they don't change their budget, lifestyle, or spending habits, and they're automatically seeing a reduction in principal balance. They're able to pull some money out along the way, and then they get to that $0 amount or their payoff amount. At that point, you've got two options that you can choose from. You can either close out the account and be mortgage free. Congratulations, you paid off your home. Or you can continue to pay the $60 annual fee that's waived the first year, and you can have access to the available equity dollars that are there. That's completely up to you. And in this example is just a perfect example of how a borrower has utilized the loan to their advantage. And this is some flexibility that a 30-year fixed rate mortgage would never be able to afford you.
All right, and now we're going to get to the hot topic of interest rates. And I say it's a hot topic, and we know why. What are the first two questions we ever ask any industry professional when it comes to the topic of interest rates? What's my rate and what's my payment? Now, in the all-in-one loan, you have three rate term options you can choose from, and they range from the 1-month adjustable to the 3-year or the 5-year fixed. Now, we do base this product off the 1-month LIBOR, and there are some things about the LIBOR that might not be widely known, and I'll share some of those with you today. One of those being that the 1-month LIBOR follows the Fed funds rate a lot closer than traditional mortgage products that follow mortgage-backed securities or the bond market. So they act and react differently to market conditions. Not only that, but over the last 25 years, LIBOR has had 4 increasing rate cycles that have lasted about 30 months on average, and it's had 4 decreasing rate cycles that have lasted about 35 months on average. So we know that LIBOR tends to come down more than it tends to go up. Now, also, the 1-month adjustable will give you the full range of 2.5 to 3 3/4 for your margin, because your fully indexed rate will be the margin plus the index. Now, because it's an adjustable, we're not going to let it adjust indefinitely. That wouldn't make sense. So we have it capped at 6%, but we also have a floor rate of 3.75, and this is really important to take note of. Even if your fully indexed rate of index plus margin is less than 3.75, you will never pay less than 3.75. That's the floor of the product. So within the all-in-one, you have 3 rate term options: the 1-month adjustable, the 3-year, and the 5-year fixed, and they are all based off of the 1-month LIBOR. You are going to have margin options. We do have a cap of 6% above your initial rate, and again, we also have a floor rate of 3.75. Now let's get into an example, because as they famously say, this is just math, it's not magic. I'm going to use that $400,000 loan example, the 3.5% fixed 30-year mortgage, against the all-in-one. Now, the interest rate that I'm using, for example, is fairly old by a few months, so it's 5.188. But I'm not so concerned with that being the current rate, because I'm using this just for example purposes. And I want to demonstrate that the all-in-one interest rate is higher than the fixed low 30-year rate. I'm going to use a borrower and a co-borrower with salary and expenses that leave them with just about, I would say, 13 to 14% left over in positive cash flow at the end of the month. Now, in the example, they make their deposit into the all-in-one, and of course, the balance is going to reduce by the amount of the deposit. But that deposit remains completely liquid and accessible for you to use as you normally use it. And just like I instructed my borrowers, they spent their money out of the account throughout the month, just like I had instructed. They didn't change a thing with how they spent their money.
And ultimately, they ended month one with a lower balance than what they started with. And there's already leftover cash or equity dollars that they can reach in and access. And that's comprised of their previous mortgage payment, $1796, plus their positive cash flow that they had. Now we get to month two, and the deposit goes in, which makes the balance go down. And of course, their spending is going to make the balance go back up. But now you'll notice their expenses also include the $1473 interest payment that was calculated in month one. So we're going to deduct the interest calculated from month one in month two. But we're still going to end month two with a lower balance than we started with, and we're still continuing to accrue available equity dollars. We get to month three, and the same process repeats all over again. The deposit goes in, and that's going to lower the balance, and spending makes it go back up. Now take a look at the interest payment for month two. It's $1465. In month one, it was $1473. What's the number one reason we continue to chase interest rates and refinance? Because we want a lower payment, right? We equate that with getting a good deal. And in the all-in-one, that happens automatically, even with a higher interest rate. Because remember, again, it's not about interest rate. It's about the size of the debt the interest is calculated off of. You're using your money to your advantage. You're putting it to work for you by keeping that balance low until you need to spend it, thereby saving yourself money and interest costs. Now, if you were to snapshot these borrowers in the all-in-one versus a conventional mortgage, just after 90 days, my borrowers in the all-in-one have a better equity position of $6,800 just after 90 days compared to their counterparts in a conventional mortgage. And you could argue that the longer you're in the loan, the more you're going to save. That's just math. But even in the short term, you're going to walk away with more principal balance reduced than you would in a traditional loan. Now, in this particular instance, the years to pay off, 30 years versus 12.6 years. I mean, that sounds good, but that doesn't resonate well with us, does it? And it won't, because we don't think of our money in terms of years. We think about our money in terms of months. So if these borrowers were sitting in front of me, I would position it this way. Would you prefer 360 payments of $1,796? Or would you prefer 148 payments of about $1,100 on average? It'll be higher at the beginning, as you saw in the demonstration, but it's also going to be a lot lower towards the end. So as a consumer that's always looking for the best value for the money you spend, always looking for the best deal, what sounds like the better deal? 360 payments of $1,796 or 148 payments of about $1,100 on average? And when you break it down to the total payments, what's totally being paid back, principal and interest, in the conventional loan, it was $646,625. Their interest as a percentage of principal was 62%. Breaking that down to the tens of dollars, for every $10 I borrowed in that loan, I had to pay back $6.20. In the all-in-one, I paid back in total $525,947, which was interest as a percentage of principal at 31%. Or if we break that down to the tens of dollars, for every $10 I spent, I had to pay back $3.10 in interest costs in the all-in-one loan. Now, the effective rate, 3.5% on that secured 30-year fixed-rate mortgage. That 30-year fixed-rate mortgage would have had to be locked in at 1.912% to achieve the same interest cost savings as my borrower in the all-in-one was able to achieve. And when you take a look at the wealth accumulation difference or the savings, again, whatever side of the coin you want to look at for that, my borrowers in the all-in-one ultimately saved over $120,000. That's not chump change. I think you would be hard-pressed to find any family or household in the U.S. that wouldn't assume $120,000 is life-changing. That's kids going to college. That's helping our parents as they get older. That's building our property portfolio or investing in our own retirement, or just doing something better for the family and the household than giving that to the bank in interest cost. And when you boil it down to the difference between the all-in-one and a traditional loan, it really is in how the payments are applied. In a traditional loan, we are bound by that amortization schedule. The bank, well in advance of our loan closing, knows exactly what our monthly payment's going to be, which is good for them because they also know how much they're going to take for interest and how much they're going to allow us to apply to the principal balance. And it's a one-way instrument, so if you decided you wanted to prepay it all, you're not going to easily have access to those dollars back. In fact, you would have to refinance or sell the home to recoup those costs, which is why, statistically speaking, as Americans, we don't prepay on our mortgages. We don't want to part with money that we might need down the road. In the all-in-one, we take a different approach and we say, go ahead and utilize the largest asset you're likely going to have in life. Use that towards the largest debt you're likely going to have in life. Pay off sooner, control your payoff timing, save money and interest costs, and have access to those available equity dollars to use at your discretion if and when you choose. So it's a win-win-win for the client. And I get asked often who this product is right for, and I think that the answer will change depending on who you ask. But if you're asking me, I say every single American needs to know they have this option available. But does that mean I think it's right for every American? Heck no, not at all. Because if money burns a hole in your pocket or you're not a good steward of your money, this is not the loan for you. There are plenty of other products out there that will help you attain home ownership, but this isn't the one that I would offer. However, if you are a good steward of your money, if you live within your means and don't spend more than you earn, and if you've qualified for a mortgage in the past, it's likely you're going to qualify for the all-in-one loan. And again, you'll have more control over your payoff timing and your interest costs. Now, people who are self-employed or are small business owners or are entrepreneurs, they love this product because of the flexibility and optionality they get with it. Same as those that have fluctuating income. People who are thinking of retired or are already wanting to retire, they love this product because it's going to help them get there without them having to change their spending habits, and they'll get to that point quicker. So I never discount talking to anyone about this product. Again, if you live within your means and you don't spend more than you earn, this product will benefit you. And then once you've decided that maybe this is something you want to take a look at further, how do you really know it's going to work for you? Well, that's where the interactive simulator comes in. And there's no personal information that's required to use the simulator, it's just mathematical information on the loan we're going to compare, your deposits or income, your withdrawals or spending habits, and then you get to the results page where you can toggle back and forth between different rate term options and different margin options. And you have the ability to go through all of that. I would recommend going through that with your loan officer initially. They're going to be able to walk you through it, but you can also go to that site on your own if you want to take a look at things.
All right, so the next steps for everyone, if this is something that you're interested in taking further, I would highly recommend that you reach out to Shireen. Her information is listed on the screen right here, so please feel free to reach out to her with any questions that you have, and she'll be more than happy to help you get into the all-in-one loan.